this shit here. Oops, exit that. Okay. Oops. Let me make these the same as here and make sure the formula is correct. Let's do 80, 40, and then 80. No, the formula got fucked up. I knew it was going to do that. What did it do here? Oh no, here, let's change this. Yeah, it's still fucked up. 3,000, 4,000. There we go. Okay, it's the same. Awesome. And then we need... Sorry guys, last thing and then we're good to go. I do apologize. I never said I was a professional. I never said I was a professional. Alright, this should be good. Laddering, martingaling, pyramiding, price, size. Yeah, I think everything's good. I know it's not the prettiest Excel sheet, but it will work. Can you guys hear me and everything? I know I had to restart the stream real fast, but is everything good to go? You guys can still hear me? Let me make sure we're live on YouTube as well. It's all good? Awesome. Yeah, it looks like we're live on YouTube as well. Okay, okay. Man, I am sore from the gym yesterday. Damn. Alright, so we're about to get started. Do you guys have any final requests? Do you guys want me to take a look at any tickers or anything before we start our video? Quick look at Ethereum and Bitcoin. Looks pretty bullish. You're still bouncing off an accumulation. You just barely missed our target on the bearish move here. You had your bearish trigger. You barely missed your target. Let's see, did you hit it on Bitcoin? Same thing on Bitcoin. You barely missed it on Bitcoin as well. It looks like it actually used... So, Bitcoin just kind of popped a little randomly here. Ethereum looks like it used this doji instead of this one here. So Ethereum actually looks like it used like this level. But that still is the point of origin. So you have not tested that point of origin yet. Alright, let me pull up my other thing here. So we can get started. And I'll use the daily as an example. Alright, let me bring this over here. I'm gonna delete all these, or I'll leave these the same for now. Yeah, we don't need that. Let me go back. I spelled this wrong here. Alright, you guys ready? You guys want to get started? You guys tired of waiting on me? Oh, you know another thing I want to go over. Let me grab this from Discord. This is another thing that I want to go over. Here's another way to enter and exit positions. Remind me to talk about this if I forget. We're going to talk about this at the end of the video. So if I forget, remind me to talk about this. Alrighty. Let me delete this. Get out of here. Close that. Turn the music off. Make sure I got everything good. Everything's good to go. Another thing that I do want to pull up are the Investopedia pages, because they're pretty good on this. Never mind. That's gonna be too complicated. We're not gonna do that. All right. No more stalling. We're gonna get started. All right, guys. So if you're just coming in, what we're gonna be talking about today are different techniques to enter and exit trades. So the main techniques that I'm gonna go over are laddering, martingaling, and pyramiding. And then I'm gonna go over a little technique that I used to use on BitMEX, and I still use time and time. Currently. But for starters, we're going to start with laddering. It's really simple. So if you haven't heard of like laddering in or laddering out, what people mean by that is instead of, so let's say we're seeing this accumulation here on Bitcoin, right? Let's say I want to get in a long, but I don't really want to get in a long at this current price. So I want to start to enter my long when price begins to fall downward. And let's say that, I'm just going to pick a random level here. Let's say that I like this level as my entry. I like that as my support. So instead of just putting a single order on that level, let's say I want to trade 10,000 contracts. Let's say I want to trade 10,000 contracts. And instead of putting 10,000 contracts right on that level, what laddering does is they're going to put little pieces all around that level. So maybe some below it, maybe some above it, and then one right on it. So let's say I split my 10,000 orders. Typically with laddering, most people put the same size on every order. Now you can do a little more advanced laddering where you weight them based on where you think the support is stronger, or if you want to weight them farther away from price to bring your average down, you can do that as well. I'm not going to go into that very advanced stuff in this video. We might do a later video on that, but I'm going to talk about the very simple side of it. So the very simple side of laddering is splitting up your orders in equal little bits around where you actually want to enter. So Like I said, if we wanted to enter 10,000 contracts, I'm going to split that up into 5 sections. I'm going to split that up into 2,000 pieces each. So 2,000 above, or 2,000 here, 2,000 here, 2,000 here, 2,000 here, and then let's just say 2,000 right on our level. So that's going to give me 10,000 contracts that I wanted to trade, but instead of just putting it all on one level, I'm going to split it up into 5 chunks. So what that is going to do is if price falls down here, but let's say it just starts to bounce a little early and it doesn't hit my entry. So if I put my entire 10,000 here and it did this, I would not have got filled. But if I ladder, my first 2 entries would have gotten filled, and then my my last 3 entries would not have gotten filled. So if it bounces early, or if it rejects early, if you're trading a resistance, if you're laddering, you can at least have some of your trade filled instead of missing the entire move. So one pro of laddering is if it bounces early, you still have some of your position filled. But the con of laddering is, what if it does something like this? And what if it comes down and you were spot on and it hits your level almost exactly and then bounces? So now if you laddered, let me put these back in just so we can visualize them. So let's say you got in a little bit there, right on the level, and then you had 2 more orders here and here. Come on, TradingView, cooperate, please. So let's say that is your laddering system. So if it comes down and it hits your entry spot on, you actually just hurt yourself because now your average price is going to be higher than if you just got in on one move. And I can show you here on Excel what I mean. So let's say our first entry was, what is that? Let's just say 74, 72, and then 7,000. So let's say 74, 72, and then 7,000. Oops. And then our fourth entry is 0. Or actually here, let's just say we got filled on a third one so this formula will work properly. Let's say we got filled at 73 as well. So just for argument's sake, I'm going to move this up a little bit. And we're going to put a third order in there. So we got filled at 74, 72, 73, and then 7,000. So let's say that 7,000 was the level that we really wanted to trade. So now your average is 72.25. If you were to just put your order at 7,000, where that level was that you wanted to trade, you would have a lower average. You would have a lower average of about, let's see, our average is 72. It would have been 7,000. So you would have a lower average of about 3 to 4%. So by laddering, if you are spot on with your level, it is actually going to hurt you. But let's do another scenario here. So let's say that price crashes through your level and then finds support and then starts to bounce. Now this would be like best case scenario for a laddering system, because what is this going to do? This is going to fill your first 2 orders. It's going to fill your main order, and then it's going to fill your lower orders as well. So this is going to actually lower your average. So let's say you got filled at 74, 72, 73, and then, or sorry, let's do the 7,000. That's going to be your main entry. And let's say you laddered another order below 7,000. Let's say it's 68. This is actually going to lower your average down to about 71. So this is not going to lower your average low enough to be below your actual entry point if you would have used the level, but you still would have got filled on that lowest entry of about 68. So that is the pro and con of laddering. If it bounces early, so for a buy ladder, if it bounces early, you're at least filled slightly. You at least get a little bit of your order in. If it bounces late, you at least get your full order in, and you actually had lower orders than if you just entered on your level. The con of laddering is if it bounces early, if it bounces spot on your level, you're only filled about half size instead of full size. So that's the con of laddering. You guys have any questions about laddering, or is that pretty simple? Laddering is very easy. There's not going to be a lot of confusion, I don't think, on laddering because there's nothing too advanced about it. You're just splitting up your orders into equal chunks, or you could weight them, as I said. So instead of trading your exact level, like let's say if I wanted to trade this doji here, if I wanted to short this doji, instead of shorting that exact doji, okay, actually here's a good example here. So look at this. So if I wanted to short this doji here, and we see a failure, and we're popping back up, and I want to short the retest of this doji. If I laddered this doji, so if I laddered, let's say boom, boom, and then right on the level, and then a couple more above, it hit my level spot on. So if I would have just put my entire 10,000 contract order on that doji, I would have damn near shorted the top. But since I laddered into it, it would have hurt me. So this would be an example of laddering not helping you, it would be hurting you. I'm trying to see if there's an example on the chart that I could use for it helping you. Yeah, so like this, if you wanted to, let's say you wanted to long this doji here. So let's say this doji is a nice support. We see a nice little bounce here. I want to long the retest of this doji, okay? So instead of putting my entire order on that doji, I'm going to ladder into it. I'm going to go 1, 2, right on the level, and then 4, 5. This would have been beautiful because I would have gotten filled on all of my orders and then it would have popped back up. So if I would have filled my entire entry on the actual level, it would have dipped below my level slightly before rising. So it would have given you a little bit of drawdown. It would still give you drawdown when you're laddering, but the drawdown would be a slightly different, depending on how you weight your orders, of course. So laddering is just a way that you can trade zones of influence without using a single order. So like if you're trading this zone, instead of using one single order, you could put orders throughout that entire block. So if it goes deep into the block, you'll fill more orders. If it goes slightly into the block, you might not fill that many orders. But laddering is going to help you trade that entire zone of influence. Okay, that's the simplest technique that we're going to talk about. Let's go into a little more advanced technique. So another technique that people use, which I despise this technique. I really do not like this technique. I think this technique is a beginner technique that people think they think it's a lot better for their trading than it actually is. And this technique is called martingaling. Martingaling is a strategy known for gambling. It's a gambling strategy. So let's say if you're at a casino table, at a roulette table, and you're betting on red and black. So you're going to start off, you're going to bet $100. If you lose your $100, now you bet $200. If you lose your $200, now you bet $400. So you're doubling your bet size every time you lose. Now in trading, people have adopted this. People have adopted this technique for their trading, and what they do is they double when they're losing a trade. So let's say you see this level here on Bitcoin, right? So you have support, 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 and then you're thinking, oh, it's going to come down, it's going to test this support, I'm going to buy it, and it's going to pop up, and we're going to be good. So let's say you enter here on, what is that, 9,400. Let's say you enter, I'm going to use Excel here to help me out. Let's say you enter at 9,400 with 1,000 contracts, okay? And then you start to lose. So let's say you enter again at, let's just make it 9,000, let's round up. You enter again at 9,000. Now you have to double, so now you're doing another 1,000 contracts. Okay. And let's say you enter again at, let's say 86. So price is falling. Now you have to double again. So now your current size is 2,000. So you have to do another 2,000. Okay. And now let's say you entered again on this little support here. So you just entered at, let's just make it 8,000, nice and round. Now you have to double again. So your current size is 4,000. So now you have to do another 4,000. So now your average entry is 84.50. Your average entry is 84.50. Your average price of all of your entries is 87.50. Let's just say the current price is whatever it is now. Let's say 80.50 is the current price. So your average entry is 84.50. The current price is 8,000. So let's take 84.50 down to 8,000. And our drawdown, as we can see here, is about 5%. So we have a drawdown of 5% of whatever our total size is. Our total size is 1,000, 2,000, 4,000, 8,000. So we have a 5% drawdown of 8,000 contracts. So let's go to the calculator. We can see how much we're down already. If we're trading 8,000 contracts, we have a 5% drawdown. We're down $400. The reason I despise martingaling is you are adding on to losing trades. And you are just consistently making your trade worse if it keeps going against you. So if the trade continues to go against you, if you just kept your same size that you started with, it wouldn't be that big of a loss. And as we can see here, let's just say we kept our normal size on this first order. This first order was at 9,400. So 9,400, where's my Excel here? 9,400, 1,000. We'd only be down $50. But because we're martingaling into our losing trade, now we're down $400. So depending on your account size, that could be massive. So adding on to losing trades is it's a bad move. It's going to have very negative effects on your account for the most part. It's going to work out if you're trading like ranges, and you are properly sizing on your. If you're properly determining supports or resistances, and it does bounce. So let's cut out these other two orders. Let's say you longed at 94, and then you longed the same size at 8,000. So that's really easy to determine your average. You can just go ahead and grab your Fibonacci, or you can just do the math in your head. So your average is going to be 87, because it's going to be halfway between your two orders. So if your average is 87, and it starts to bounce like it did here, you were actually slightly positive, and you could have closed that trade break even. So if you actually determined this support properly, and you did not add on this massive dump here, and it started to bounce, you could have closed your trade break even or for a slight profit. But if you are not determining those supports properly and you are doing what we were showing you earlier, where you're just taking these trades while price is dumping, then you are going to lose a lot of money. So if you were failing, God, TradingView is not cooperating today. If you were failing to determine this support and you were just adding during a dump, your average price would be much higher than if you properly determined that support. So one technique for martingaling is starting with very low leverage and building up. So let's say I typically trade, I don't know, 4x leverage. Let's say I typically trade 4x leverage. So what I'm going to do is, on my first order, I'm only going to trade, let's say, 0.5 leverage, depending on how many times you want to martingale. So I'm going to trade 0.5 leverage on this trade. So when I double it, now I'm at 1x leverage. And when I double that, now I'm at 2x leverage. And if I were to double it again, I'd be at 4x leverage. So on my fourth order, I would now be at what my normal entry size would be. Does that make sense? So instead of putting 4x leverage on my first trade, you're doing 0.5, doubling it into 1, doubling it into 2, and then doubling it into 4. So on your fourth order, you are now officially in 4x leverage, and your average is going to be somewhere in the middle of your entries. So somewhere around here. Instead of just putting 4x here, and then it nukes downward, and you lose that trade. Now, there's downsides to this, obviously. So if I took this support bounce on 4x leverage, and it bounced, I would be in a very good trade. I would be making a lot of money. If I martingaled and I was actually right, I would have made far less money than if I was 4x. Because if you start with a martingale at 0.5 instead of 4x, you're losing out on a ton of profit. Because your normal size compared to your first entry on a martingale is going to have an 8x difference. Because 0.5 times 8 becomes 4x leverage. So you're going to have an 8x size difference on that support bounce. So that is the massive con in martingaling if you're right. The massive con in martingaling if you're wrong is you're just adding on to a losing trade, so you're bleeding more and more as price is falling. So if you were to continue to go down here, and what did we say our average was? So if our average here is 84.50, and I'm already in full size. So I'm in a full size trade at 84.50. If this continues to fall, I'm already on a drawdown of 5%. How much of a drawdown are you going to accept before you cut this trade? You're already on a drawdown of 5%. And if you're trading any kind of leverage, let's say you're on 4x leverage, you're already down 20% of your account. So how much longer are you going to let this go against you before you close your trade? So if this goes down to 75, and I'm still in my full-size martingale, we're now down, let's just make it around 10%. So if you're using 4x, 5x leverage, you can see that could be a massive problem. You are now down 40 to 50% of your account in one trade. So I do not recommend using martingaling unless you're using some kind of like high leverage scalping system. I really do not recommend using it. It is a very quick way to, I shouldn't even say this because it's probably going to get some of you to use it, but it is a very quick way to build an account, but it's also an extremely quick way to destroy an account. I showed this with a competition in my old Discord. We had a trading competition. For the first few weeks, I used a martingaling scalping technique, and I was I basically doubled the account pretty quickly. I was up like 30, 40, 50% very, very quickly. And then on one single trade, I lost all of my gains plus like 30% of my account on one loss. So I ended up not taking any losses for like my first 10, 15 trades, but on one loss, it obliterated my entire account. So yes, if you are doing it properly and you're getting lucky, because it really is getting lucky for the most part, you can build an account pretty quickly, but on one loss, just know that your account's either going to blow up or you're going to lose most of it. So be very careful. Like I said, if you really like martingaling, I would start with a very low leverage and build into it. Do not ever start with a high leverage, because think about it. If you're martingaling and you start with 2x, you have to double. So now you're on 4x. Now you're on 8x. Now you're on 16x. So you're 16x your account and you're in a losing trade. Does that sound like something you want to be in? I don't think so. Do we have any questions on martingaling before I move on to pyramiding? Pyramiding is my favorite technique. Or probably my second, either my first or second favorite. I'm going over another technique after pyramiding that's also very good. Okay, I don't see any questions, so I'm going to move forward. And actually, before I go to pyramiding, I'm going to quickly talk about DCAing, but I can't really show it on a chart too much. It's very simple. It would take me a long time to kind of calculate your average, but I'm just going to talk about it a little bit. So when you hear about DCAing, a lot of people mistake DCAing, which is dollar cost averaging. A lot of people mistake dollar cost averaging for martingaling. So what a lot of people think DCAing is when you're in a losing trade, you just keep adding on to it to lower your average. That's what they think dollar cost averaging is. That's not what it is. Dollar cost averaging is, for example, if I have a, let's say I have a Coinbase account, and I think Coinbase lets you do this. You can put in, I want to buy Bitcoin every Friday for $100. Like I want to buy $100 worth of Bitcoin every Friday. I don't care what the price is. I just want to buy Bitcoin every Friday with $100. So if price goes down, you're going to be averaging down. If price goes up, you're going to be averaging up. And then slowly you're going to build a position. So if you're like a long-term investor, and let's say you started to dollar cost average during this accumulation. Anybody who was dollar cost averaging during this accumulation made a lot of money, because look at what Bitcoin did. So if you are a long-term investor and you start to see some long-term accumulation like this, and you really believe in the asset, you believe the asset is bullish and it's going to rise eventually, dollar cost averaging could be a very good way to make a long-term trade profitable. Because if you took, let's make this simple. Let's say you took $1,000 every month. So you bought $1,000 worth of Bitcoin in December. You bought $1,000 worth of Bitcoin in January, February, March, April, May, June, and let's say you just turned it off in July because July just mooned. Even if you did buy in July, it probably wouldn't have raised your price too much. So dollar cost averaging, you don't want to change your size. You typically want to keep the same size. So whatever you used for this order, you want to use for this order. You don't want to change your size. Now, obviously, if you're making a lot of money at work or your lifestyle has changed and you can put in a lot more money, then yes, you can do that. But what I'm saying is you don't want to change your dollar cost average every single week or every single month. Now, obviously, if it's like a new year or a new quarter and you're like, hey, man, I got some more money, I want to invest it, then yes, you can change it. But if you change it, make sure you keep it the same moving forward. So like, if you have some more money in January, let's say you want to invest $2,000, Okay, make sure you have enough to invest 2,000, 2,000, 2,000, 2,000, 2,000. Don't just invest 2,000 in January and then go back to 1,000, because that's going to hurt your average. If you're a long-term investor, it's going to affect your average. Because what happens if you invested 2,000 in January and then you nuked in February and you don't have $2,000 to invest in February? It's going to hurt your average. So make sure you keep if you're dollar cost averaging, make sure you try to keep how much money you're investing relatively the same throughout the period of your investment until at least you sell it. And then once you sell it, you can restart. But yeah, so anybody who dollar cost averaged, even if they started to dollar cost average during this accumulation, they still would have made money. They still would have done it very good. Because if you look at, let's say you put in $1,000 in September, you put in $1,000 in November, you put in $1,000 in December. I think December was here, so you have a double December. But you can see that you would have lowered your average. Your average would have been somewhere probably around here. And then you would have raised your average a little bit, raised it a little bit, probably would have been somewhere around here. And then it would have mooned. And you would have had a very good investment. Now, historically, looking at Bitcoin, dollar cost averaging is a very good strategy. As long as you're not dollar cost averaging during massive bull runs and you're dollar cost averaging during accumulation, historically it is a very good strategy. It's like looking at the S&P 500, look at the SPY. So historically, if you're dollar cost averaging into the SPY, that is a very good technique. So if you start to see very big dumps on the SPY, you can start to dollar cost average. Or you could even slowly dollar cost average as it's rising, which would be kind of like pyramiding, which we're going to talk about here in a little bit. So if you find things that historically are very strong, trending upward, those are good assets to dollar cost average when they begin to accumulate or when they begin to enter kind of bearish markets. Okay, so that's dollar cost averaging. Quick recap. Dollar cost averaging is building a position with the same size at time intervals. So weekly, monthly, quarterly, yearly. You don't care about price action. You don't care about fundamentals. You just invest slowly into an asset that you think will do well long term. That is proper dollar cost averaging. All right, we're going to move forward to pyramiding. This is one of my favorite techniques. It's kind of like dollar cost averaging, but it's only when you're winning trades. Okay, so for pyramiding, what you're going to do is, and I've done this a lot in Discord, instead of entering a full-size trade immediately, let's say that I want to trade the breakout here. Let's say that I saw this resistance come in here, I saw this nice accumulation, and I wanted to trade the breakout. So instead of taking the breakout trade full size immediately, I'm going to take, like, let's say half size on the break, and then I'm going to build into it as it goes in my favor. I'm never going to build into it if it goes against me. Okay? So let's say I enter half size here. So what's that price? That price is 8,800. Let's say the price is 8,800. My full size is 10,000. Let's say my half size is 5,000. Okay? So now, once it's pushed upward a good bit, and I feel safe to raise my average, I will add on again. So let's say that I see the break of this little red candle pull back here. And I'm like, okay, if I add on the break here, it's going to raise my average. But I'm okay to raise my average here. I feel comfortable raising my average. So I'm going to add another, let's say, I've got 3 orders left. So let's say I add another, let's just say 2,000. So now the price is 9,400, I believe. And let's say I add another 2,000 contracts. Okay. So the next point that I feel comfortable adding, let's just say it starts to break out here, and I feel comfortable raising my average again. This looks really strong, looks like a really healthy pullback. Let's just say there's really high buy volume. I'm very comfortable with this going higher. So I'm going to go ahead and add another order. Let's say we add another 2,000. And let's just say the price is around 99. Okay, so now I have 1,000 contracts left. So once it starts to kind of pull back and it starts to find some sellers, people are taking profit. If I still believe that it can go higher, I'll add on my last piece. So let's just say if I go down to a lower time frame here, during this little pullback, I added my final piece. So now let's say I added my final piece at like 10.5. So now we have 10.5, and then I have 1,000 contracts. So this is going to raise my average to 93.10. And I'm going to have, this is going to be a long position, so I'm going to have, what is that, about a, oh yeah, I need to do the current price. So let's say the current price is, let's just say 12,000. So current price is going to be 12,000. This is going to give me about a 29% gain. So the pro of pyramiding is, let's say my first entry, where I first got in this trade, was what? I wanted to see a break of this resistance, right? So if I would have just entered full size right here, I would have had 0 drawdown, and we would have had a massive profit. My entry would have been lower. I would have had 0 drawdown. It would have never scared me out of the trade. And we would have had a massive profit. So the con to pyramiding here is I raised my average, and I would have made less money. I would have made less profit because my average was closer to my exit. The pro of pyramiding here is, if I would have taken this breakout trade, and if you guys trade Bitcoin, you know this happens a lot, it could have faked me out. I could have taken this breakout trade, and then it could have instantly pulled back and nuked. So if I took a half-size position here, and it started, here's a good example. So let's say I took this breakout trade here. If I took this breakout trade in full size, I probably would not have taken profit on that tiny little move there. That's too small of a move for me to take profit. So if I would have taken full size here, and it faked out and pulled me back and pulled back, it would have stopped me out probably. But if I would have pyramided into this and I took half size, I'm more comfortable with using a wider stop loss because I'm in a half size position. And I'm not going to add on to a losing trade here, which in this case, it would have actually helped you, but for the most part, adding on to losing trades is very bad. So if I would have taken half size here and it faked me out, I would most likely have not gotten stopped out. And even if I would have gotten stopped out, I would have only lost half of the money that I would have lost if I was in a full size trade. So let's just say I didn't get stopped out here and I pyramided here. It would have basically been the same as pyramiding here. So now that I see that clean SR flip, you saw that resistance turn into support. Now I can start pyramiding into my order, into my trade. So here's my first entry, and then second, third, fourth, fifth, depending on how many times you want to add on to it. I typically won't add on if price is very far away from my entry. I'll take a little bit of time and I'll add on a few times. I don't want to add on too close and I don't want to add on too far. The basic technique that I use when I'm pyramiding is, if I'm in a breakout trade and it has a first pullback, kind of like a bull flag, I'll typically add on there. That will be my first add. Another time I'll add is if I take a breakout trade, if it pulls back to like my entry, and then it starts to bounce again, I'll add on there as well. Another time that I like to add on is if we are breaking out, it finds a resistance, and then it breaks that resistance. That's another good adding opportunity. And this is all the same for shorting as well. Just flip it for support. It's the same as shorting. So just to recap, the pro of pyramiding is you start small and you build into winning trades. The pro of that is because if you start small and it instantly goes against you, you're only losing whatever that size is that you started with. You don't have to start with half size. You can start with like 75 or 80, or you can even start with a full size if you really want to. If you want to start with a full size and then build into it to make it a bigger position, so if you want to trade like 2x, 3x, 4x, you can even do that. So if you're somebody who likes to trade higher leverage, and let's say you would take like a 4x trade here, instead of taking 4x, the safer bet would be to take like 1x and then build into it. Because it prevents you from getting stopped out immediately on a full size position. And it prevents you from adding water to a sinking ship. If you keep adding on to a losing trade, you're just filling a sinking boat with water. You're just constantly putting more water into it, and you're sinking more and more and more until you're finally completely underwater and you've lost your entire ship. So that's the pro. The con of it, obviously, is like we said earlier. If you were to just take a full-size position here, and it rocketed upward, you're going to make less money if you pyramided than if you just took a full size. You're basically paying for security. You're paying for safety. And that's why it's so strong for disciplined traders, because it gives you that little bit of security for your trade. And if you're somebody who constantly gets stopped out early, if you're someone who gets in a trade and it instantly goes against you, pyramiding is probably the technique that you want to test out. And that's what used to happen to me when I first started trading. I would get in a trade and it would go against me almost immediately because I was just reading the market wrong. And if you're someone that happens to quite often, I highly recommend testing out a pyramiding technique. Does anybody have any questions on pyramiding before I move on to our last technique? This technique is a personal technique that I use quite often. So this last technique is a little different. So the first thing you're going to do is, so before I get into this actually, when you're trading, you should always know where your stop loss is before you get in the trade. Not after you get in the trade, not while you're in the trade, just kind of looking for stop losses. No. You should know where is a good stop loss if I enter right now. If you follow that technique, you can use this entry and exit technique to determine how many contracts you should trade. You said, which percentage of your account do you risk on each trade? It really varies. It really varies on how good of a trade I think it is. But for the most part, I don't risk more than like 3 to 5%. On my riskiest trades, it's probably 5%. My average trade is probably 1 to 2 to 3. But on the riskiest is probably 5. And that's like really risky. That's like trading high leverage. But for the most part, I don't risk more than like 2 to 3%. Okay, so with this technique, this will help you determine how many contracts you want to trade. So let's say we want to take a trade here. Okay, so I want to take a trade. I want to take a long here, right? So let's grab my long tool. Where is my stop loss going to be? Let's say my stop loss is below the range. Let's just make it an even 5%. Let's say it's 5%. Okay, so that's step 1. Find where your stop should be. Step 2, determine the percentage change from current price to your stop loss. We've determined that it's 5%. Step 3, determine how much you are willing to lose. This is your dollar value. This is your bet. So think of this as like if you were at a casino and you go to a table, if you're at a blackjack table or a roulette table, whatever that money is that you put down on the table, that's how much you're willing to lose. So if I put $50 on black and I'm wrong, I was willing to lose $50. That is my bet. Okay? So think of a trade as you would think of a bet. So if I'm willing to lose $100, the percentage change from current price to my stop loss is 5%. You divide your bet from step 3 by the percentage from step 2. This becomes how much notional value, how many contracts you want to trade. And you need to remember to turn this into a decimal. So 1% would be 0.01. Okay? So if I'm trading, let me grab a calculator here. So if I'm willing to lose $100, if I'm wrong, my stop loss is 5% away. I'm going to divide by 0.05. This is how many contracts you can trade so that if you lose, you will lose your bet. Now, this isn't an entry or exit technique. This is kind of just a bonus to this video. This is how to determine how many contracts you should enter. I guess it is kind of an entry technique. It's how many contracts you should enter with. So let's say my stop loss, let's do another example here. Let's say I wanted to short this. I want to short the breakdown. My stop loss is 18% away. I don't know why you would do that, but let's just say you are going to do that. Let's just say you're going for a 1-to-1 trade. So your stop loss is 18% away. Let's say you're willing to lose $1,000. So if you're willing to lose $1,000, your stop loss is 18% away. That means you can trade 5,555 contracts. Does that make sense to you guys? So an easy way to determine this is, okay, let's say that I have a $10,000 account. I don't want to lose any more than 2% of my account. Okay? So if I don't want to lose more than 2% of my account, I don't want to lose more than $200. So my bet on the trade is $200. So I'm betting $200 that Bitcoin will, if it breaks below 9,300, it will hit 7,600 before it hits 11,000. Okay, so you're willing to lose $200. Your stop loss is 18% away. Oops, what did I do? $200. Your stop loss is 18% away. You can trade 1,111 contracts. Very simple. Very, very simple. This will help you make sure that you are not losing more than you want to lose. Because a lot of people have really, I don't know why, but they struggle with figuring out, like, hey, if I get stopped out in this trade, how much money am I actually going to lose? So hopefully that will help you guys out. So once again, here are the steps. And if you're watching on YouTube or Twitch, you can pause the stream and you can write these down. Step 1, find where your stop loss should be. Step 2, determine the percentage change from current price to your stop loss. Step 3, determine how much money you are willing to lose. Step 4, divide your bet from step 3 by the percentage from step 2. This only works if your contract value is $1. If the contract value is not $1, you have to adjust it to whatever the contract value is. So for Deribit, you need to divide the answer by 10. That will give you the proper answer. To determine leverage, you want to take your answer from step 4 and divide it by your account value. That will determine how much leverage you are using. Let me just delete that for now. Here we go. Do you guys have any final questions? Because that covers just about everything from our for our video. If you guys have any final questions, feel free to put them in chat. If you guys have any questions on YouTube, as always, feel free to put them in the comments and I'll get to them as soon as possible. If you guys liked this video, please do not forget to hit that like button on YouTube. If you're watching the live stream on Twitch, I would very much appreciate if you guys could give it a like on YouTube as well. So what I'm going to do is I'm going to cut out most of this video from the stream and I'm going to make it a nice little clean highlight video that I'm going to upload on YouTube later. So it will be uploaded in 2 pieces basically. But alright, I'm going to go ahead and end the YouTube video. So I appreciate you guys watching. If you guys did like this video, make sure to hit that subscribe button. And I will be coming out with some more content down the road. Appreciate you guys watching. I'll see you guys next time. Alright, that's the ending of the YouTube video. You guys have any final questions for me on stream before we get going here? Guess I could save this for later. My average back then was 4,200. Was scared when we approached 3K. Yeah, no, it was getting pretty scary back then. Looking like Bitcoin was gonna die. Jesus. What's first, 9K or 7K? If I had to choose one right now, I'd probably say 9K. You have an accumulation. As long as the accumulation holds, I'd say 9K. If the accumulation breaks, 7K. To be more exact, if this gets back above this level here, I'd say 9K. So back above 82, 9K. If it gets back below 78, 7K. I know that's kind of a cop-out to your question, but that's what trading is. Man, we should have gotten filled on that trade. You gotta love the morning birds, man. Early bird gets the worm, right? All these trades happening during the morning hours. Seems like the Chinese Open and the New York Open are driving price action. It's really sad we missed all these trades. There was a lot of really good opportunities in October that we did not hit due to the time period of these trades. This trade was brutal. This trade was one of the trades that I was actually on my PC trying to trade, and we got screwed by overload. This one trade would have made our entire October. Even if we captured half the move, it would have been fine. It really sucks. It really sucks looking back at October and seeing how many trading opportunities just were not possible to trade. It really sucks. October could have easily been bigger than September. But alright guys, I'm going to call it on that. I appreciate you guys being here. The last day was a really good example for the range video you did the other day. Yeah, it was. It was definitely. I was looking at that. We were just talking about this. So if you guys watched that accumulation distribution video, we literally just talked about this. So, beautiful, beautiful stuff. But alright guys, appreciate you guys being here. Tomorrow, I'm probably going to do a TrendSpider video. So, we're going to talk about TrendSpider's new strategy tester, and I'm going to go over a little bit more of their platform tomorrow. I'll catch you guys tomorrow, probably around. Never made a lower low on October bottom. What do you mean? No, we haven't. We don't have a lower low. Not on the daily. But alright guys. As I said, if you guys could go to the YouTube video once it's uploaded and give it a like, I'd really appreciate that. If not, no worries. But I will catch you guys tomorrow around 3 to 4 p.m. Eastern. So make sure you guys have my notifications on. You can see when I'm going live. Or just make sure you're following me on Twitter. I'll let you guys know what time I'm going live on Twitter as well. But alright guys, you guys have a good day. If I don't see you tomorrow, have a good weekend. Peace out guys.